Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren.
Hey everybody.
Hey Lauren, I wanted to follow up with that last episode that we did about doomsdayers, doomsdayers, and there's been a lot of market volatility where we're seeing some really big declines in the stock market indexes on a given day.
Yeah, that's right.
And when this is actually shown to the public, which I don't know exactly what's happening in the stock market at that time, but as of today, the market's dropped like 3 consecutive days. Okay?
Right.
And a lot of it could be, argued it's because of the Japanese earthquake. It could have been about the nuclear fallout. It could be all kinds of different things, or the impact on the global economy. The thing about it is when I see volatility, I see opportunity, and I know you believe in that too.
Right.
Volatility can provide return, and I want to talk about that. But the one thing I just wanted to bring up is I wanted to show in pictures how volatility looks, and then if you kind of take a longer point of view, it doesn't look so bad.
Right. Okay.
And because the charts that I can print off the computer are hard to read on this video, I actually decided to be an artist today.
Okay. All right.
And so, and I apologize for that because I am an accountant. So what I did is I actually duplicated the chart in my rough left-handed handwriting.
Okay.
And this is what the chart looked for 5 days. Here, I'll show this to the camera here in a second. This is what the 5-day U.S. S&P 500 stock market index looked like for the last 5 days. Can you see that okay in the camera? Thank you. And the reason I wanted to show this one is because this is what's happened recently, and this looks pretty volatile.
Oh yeah, oh yeah.
It looks painful.
Exactly.
And the reason I wanted to show this to you is because this is when people start thinking about, okay, how should I invest? Should I move my money? Should I go to cash? Should I go to gold? What should I do? Okay. Now I want to take that same stock market, and I want to show what happened as of today, the last 2 years. Okay.
Right.
And where it started on the lower part of the page, that's where it was 2 years ago, and this is where it's at by my finger today. Looks a little more smoother, but also you can see it's trended upward.
Right.
All right. So if people use that as their investment analysis, they would say, okay, don't feel quite so bad because we've seen some really nice returns in the U.S. stock market. And by the way, there's other indexes like emerging markets and ones like that have actually done even better than this.
Right.
I just want to use this as an example. Okay. The last one I want to show is, and the reason I like to show this one is because this one actually encompasses many decades and also many tragic events, such as World War II, the nuclear bomb being dropped down in Japan, Vietnam War, oil crisis in the 70s, all the way up till today. And it's hard to read, but this is what it's going to look like.
Right. Yeah.
You can just see though that it's much more stable on that, where it goes from the bottom all the way to the top, much more stable looking. But again, the trend is we're getting return no matter what happened with all these different events over past history. So I have nothing. I don't know about you, but Lauren, I don't have anything to believe that this return on investment over the long run would not duplicate itself in the future. Don't know exactly what the return is going to be.
Exactly.
What do you see as opportunity with all this recent volatility going on?
Well, the recent volatility. I mean, the first thing about it is that if you have something and it doesn't ever have this kind of short-term volatility, that's something that's not going to get high long-term returns. It just isn't. So
this actually could help improve returns.
Well, yeah,
in the long run.
yeah, well, yeah, exactly. I mean,
sense.
the reason you get returns in finance is because you took risks.
Okay.
And I mean, that's just how the world works. And then the other thing is, on a monthly or a quarterly basis, there are still ups and downs. You can see that in the chart or the 2-year chart. You can even see yearly ups and downs in the really long chart. When we have portfolios that combine stocks and bonds, when it goes down, we buy more stocks. When it goes up, we sell some of those stocks. And those are the opportunities. Those are the opportunities to make money is when things go down, actually. I mean, that's when you have higher expected returns is after things have gone down.
And so in a perverse way, I'll summarize this episode. In a perverse way, volatility can actually be good for your portfolio as long as you're a long-term investor and you are disciplined about it.
Oh yeah. It's what you get paid to put up with. I mean, it's not like the volatility just floats in from outer space somewhere.
Right.
I mean, the volatility happens at precisely the time when you're going to be most nervous about everything else.
That's
why it's risk.
New and unknowable events.
Right. Yeah. And I mean, that's why it's risk and not just sort of a game.
Okay. All right. Well, I appreciate that. So, Lauren, thank you very much, and we'll see you on our next episode of Erickson TV. Bye now.
See you next time.